be learning how to use and then apply Bollinger Bands. And they're very easy. Now, before we get started tonight, let me tell you that starting next year, which is in a couple days, we have a whole new education format. We have different class dates, and we have completely new courses for you. We'll be teaching more courses directly on the platform and showing you how to use the platform to use whatever we're talking about in class. So when we teach Bollinger Bands next year, we're going to be showing you right on the platform and getting you more familiar with how to use our new Trader Pro platform. And we have a lot of new classes. The first class of January will be on order entries, stop losses, and leverage, which is a brand new class. So make sure you join us for those. Now, Bollinger Bands were created by legendary money manager and researcher John Bollinger. It is actually one of the few indicators that Bollinger still maintains his Bollinger Bands website and keeps it updated, so you can actually go after class and go over to www.bollingerbands.com and you can learn how Bollinger developed this and the strategies and how to use it directly from Bollinger, as opposed to going to the internet and finding all of these gurus who want to teach you how to use their system. But he's also been keeping track of all of his trades in the original Bollinger Bands for 20 years now, and for his new Bollinger Band B and Bollinger Band Width for the last 13 years. So you can see the results of how Bollinger Bands, has been over a lot of years. Now, originally, Bollinger Bands were developed for the stock market because when they were developed, there was no other online trading, and almost everybody was trading just stocks. And then he modified them 13 years ago to fit Forex and commodities. And he's been following along for the Forex and commodities, and they work great for CFDs. You just have to slightly adjust your interpretations depending on the markets. And tonight, what we're going to be concentrating on will be, of course, the Forex market or the CFD market. Now, there has been an abundance of information published on how to trade with Bollinger Bands, but much of it is discretionary in theory. And how to use Bollinger Bands information usually pushes it back to the trader to interpret what the securities price is doing relevant to the bands. Now, Bollinger Bands fall in an area that we consider technical analysis, and they fit in with envelopes. So before describing strategies, we have to look at what exactly Bollinger Bands are and where do they come from, because you have to understand how they're getting on charts before you can understand how to use them. And they're not very complicated to do, because today they are so popular. Every charting service, including the charts on the ETX Pro platform, you just click on the charts and click on Bollinger Bands and it drops it on there. But you have to know what you're dropping on your chart, because you have to know what it's trying, where the data comes from, and what it's trying to tell you about the markets. So Bollinger Bands uses 3 lines. It uses, number 1, a moving average line, and then it uses what's the upper band and the lower band. Okay, and these upper and lower bands create the Bollinger Band in the center. And these upper and lower bands use what's called standard deviation, which is a very complex mathematical calculation, but it's based on the average or the mean and how it diverges from price. But the fact is, this upper band and the lower band show you the volatility in the marketplace. The wider the bands, the more volatile the market. The narrower the bands, the less volatility in the marketplace. But you have to understand where they actually come from, okay? Because it's important, because if you understand the basics, then you can use your brain and your own mind to make the interpretations or see when the markets are doing something they shouldn't be doing, so you shouldn't be using the interpretation. Now, Bollinger Bands can be applied in all financial markets, including equities, forex, commodities, and futures. And the nice thing about Bollinger Bands, they can be used in any time frame, from a very short period to hourlies, dailies, weeklies, or monthly charts. So most of us here are trading in very short time frames. Most traders that trade forex and CFDs are trading in less than a day or 1 day or 2 day period. And there's very few indicators, and unfortunately most people don't realize that a lot of the indicators they're using don't work well in short time frames. Bollinger Band is one that works very well in short time frames. And one of the first questions that Bollinger Bands answers is, are prices high or low on a relative value? And by definition, price is high when it's near the upper band of the Bollinger Band, and price is low when it is at the lower band. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope, hence the name band. Trading bands and envelopes serve the same purpose. They provide relative definitions of high and low that can be used to create rigorous trading approaches and patterns, and pattern recognition, and much more. Bands are usually thought of as employing a measure of central tenacity as a base, such as a moving average, whereas envelopes encompass the price structure without clearly defining a central focus. So Bollinger Bands uses the moving average. And it uses these as a standard deviation. And we're going to use that a lot because it's too complex for you to actually understand, but you have to understand that Bollinger Band uses what's called a 220 standard deviation. So by default, the Bollinger Band is set to a 2 standard deviation. The standard deviation, it's a mathematical calculation that measures the distance from the mean. And like I said, it's a complex formula. In its simplest form, the mean is simply the average of all the data points in a given set. In investing, for example, you might know that the mean closing price for the last 20 days. Mean average, simply an almost moving average. This can be obtained by adding the closing price for each session and dividing it by 20. Because markets are fickle at best, traders and analysts use moving averages to adjust daily to incorporate most updated data. But here's where we get complicated. And I don't expect you to know it. I don't know it. I can't repeat it without reading it. Okay. But what is a standard deviation? Standard deviation is calculated based on the mean. The distance of each data point from the mean is squared, summed, and averaged to find its variance. Or to put it another way, variance is derived by taking the mean of the data points, subtracting the mean from each data point individually, squaring each of these results, and then taking another mean of these squared. Okay, standard deviation is simply the square root of the variance. Okay, well, I don't think any of us could do this by hand. And I don't think any of us really want to spend the time and the effort doing the mathematics. And nobody does. Even scientists who use standard deviation, they rely on a computer and they put in standard deviation of 2 or 20 or 17 or whatever what they're working on, and the computer does it all for them. So with Bollinger Bands, we end up with 3 lines. We have the baseline, which is the 20-day. Now, there are people out there that use 2.5 and 22. Okay, these become trading systems. Bollinger developed this using what's called a 220. It's a 2 standard deviation based on a 20-day moving average. So the baseline on a Bollinger Band is the moving average line through the center, which is usually a 20-period moving average. Then we have the upper band and the lower band. Okay, the upper band is spread above the moving average by a volatility measure called the standard deviation, set to a 2 standard deviation. So it's all those things that it did by 2 above the band, above the moving average, and the lower band is the exact opposite. It subtracts the standard deviation, or -2, and it gives us the band around the moving average. So what we see is, what we've created is the moving average, and then with this mathematical calculation that the computer calculates, it puts an upper band on there at a 2 standard deviation, and then puts a lower band on there as a 2 standard deviation. So this band and this band are moving in the reverse image of each other, and then you have the moving average. Okay, and this is a Bollinger Band. Now, that being said, we don't have to do or worry about any of this. Let's go over to a live chart. Let me get my marker off of here. And actually, we're looking on the chart. So we're going to go right here. This is a chart on TradingView. We were looking real quickly at the chart on the ETX platform. We're going to go back to the ETX platform. But we just find no matter what charting service you're using, they're going to offer Bollinger Bands. So we click over here on the indicators. We just scroll down to Bollinger Bands. And it's already dropped it on the chart. And when we look at it, the settings, okay, and I'm going to make this bigger and broader for us. I'm going to make the upper and the lower band blues, just because I like blues better. And I'm going to make the moving average an orange color so you can see it easier. And we'll change the background color to be a pale blue. And now when we look at the inputs, we can see it's using a 20-period moving average. Right here, we see the length. We're seeing the standard deviation set at 2, and it's using the close of each price. Now, you can adjust this and use the median price. You can use it the opening price. But again, Bollinger developed this using the close price. And it's on our chart. So we no longer have to do any of these calculations. We don't have to worry about it. This is it. Now, I adjust my Bollinger Bands in my personal trading, and that's for using it for 15 years, to a 2.5 instead of a 2.0. It gives me less signals. It moves the bands a little bit wider, only because now I know how to use Bollinger Bands, and I've adjusted it to my own personal use. I would like a lot less signals, and this is what happens when you use a 2.5. Because it moves the band farther away from the moving average. Because when the price comes up to the upper or the lower band and either violates or doesn't violate, it tells you something. But we don't need to get onto that yet. So right now, we've simply put this Bollinger Band price, or this Bollinger Band indicator on our charts. It was pretty simple, wasn't it? If you're on the ETX platform, again, here we're looking at the Euro US dollar. We've gotten a 15-minute chart. We clicked on our indicators Bollinger Band. It opens up a panel on the right-hand side, and we can see here we've used a period of 20, a standard deviation of 2, a simple moving average is applied to the close, and we use the blue color here, and I made the band with 3 so I could see because my eyes are old and I want to see it broader. That's it, and it's on directly on our ETX charts right on our platform. So you can use, and these charts on ETX are very fast feeds and very up-to-date prices. And you can use them right on your platform. And you can also just click on here and you can make them full screen and do whatever you want. You can add all the technical indicators. So you don't have to have a private charting service. You can save your setups and formats and everything else with our charts. And like I said, next year, we'll be doing everything right on this platform. So we'll be teaching you from these charts and how to use these charts. So we have a class in understanding charts or building your basic foundations. And I'll be teaching you all about charting on the ETX platform. But right now, that's what we're looking at is right here on the ETX. But we're going to go back over right now to the trading view charts. And let's go back actually to my PowerPoint and let's get past actually putting these on a chart. Let's talk about what they're going to be used for and how you could use them in your trading. Okay, if somebody popped up a question and said they can't be here for the whole class, every one of our webinars is always recorded. Okay, to see the recorded version in about 24 hours, just use the same link you used to come to tonight's class, and it will take you to that recorded version of the class. Now, we use Bollinger Bands for three primary uses. One is pattern recognition. We can actually see double tops, double bottoms, and head and shoulders inside the Bollinger Bands. We also use it for reversal signals. It'll help us identify early warnings of trend reversals. We also use it for trend analysis to detect trend continuations or the end of a trend. So Bollinger Band gives us a lot of information. So we're going to go over shortly to my favorite part of Bollinger Bands, which is the %B, which is one of the newest parts of this indicator that Bollinger Band added about 10 years ago. And it makes it very easy because you can see all of that's happening with Bollinger Bands in a little tiny concise chart below your charts on your, and a little indicator below your charts. But let's take a first bite at how to using this. So the most popular thing to see and the easiest thing to see are patterns within the Bollinger Band. Because the Bollinger Bands forms, like I said, they expand and contract based on volatility. The more volatile the markets, the wider you can see the band. The less volatile the markets, the more contractive bands will be. The shape of the band, though, doesn't tell you anything. And you'll see odd shapes. I've seen them look like aliens. I've seen them look like worms and tadpoles. Doesn't tell you anything. What you do see is the relationship to price within the band and the reaction to price, whether it's a bar chart or a candlestick chart, in relationship to the upper and the lower band lines. We have things called like riding the bands, and we're going to talk about those in a minute. But right now we're looking at patterns we can see in the bands. So there are two shapes that we see in the bands, and they're called double tops or double bottoms. But for bands, we move them over to M's and W's. And an M is a double top. A W is a double bottom. What you're looking for right now is a double bottom. Okay. Now, they're going to tell you something when you see these, but first you have to recognize them. Now, you won't see it off the bat, but what we're going to look for is what we call the N. You have an upside down N and a regular N. Okay. When we see the formation of the N, which is the first, second, and third part of the M, because an M or W has that fourth swing. When you see the N form, and in this case, we have the first bottom and is formed by making the second bottom. But until that N is actually completed, you have no idea that you're seeing a possible double bottom. When you do this, these are very strong reversal signals, telling you that that trend is now about to reverse. You also see the M pattern, which you see here, which is a double top. So a bullish bottom pattern is formed by two successful bottoms in price action, which typically resembles a W. Now, although it is first that will resemble an upside down N. Okay. Then when you see the upside down N form, you realize you're in that beginnings of the development, or you're actually within a W formation. If you see it in the top, if you see it with a double top, you see the right side up N. The key lies in establishing bullish positions near the lower Bollinger Band with a target set to the upper Bollinger Band. So when it hits the bottom of the Bollinger Band down here and forms the N, you would be looking for a target or an entry point with the projection being the top of the band moving upward. Or the reverse when you have the double top. So a bearish top pattern is formed by two successful tops in price with the opposite of the W that forms the M. Before forming the entire M, an N will emerge in that price action, and this is the point at which traders should want to get involved. When at the second peak and the N has been formed by the asset price action, it is time to establish a bearish position in the trading asset. Should price continue to rise after the fact and move higher above the second top, it is a signal to exit and wait for new opportunities to arise. So although we highly recommend combining Bollinger Bands with RSI. RSI and Bollinger Bands work together hand in hand. So there are two types of tops that you need to know about. You have after a trend move, price fails to reach the outer band. So when price is moving up, to form the top, it is formed when price is unable to break that, to breach that upper band. So in other words, we see price here pushing up. It is forming the top, but you see it's unable to breach that upper band. It pushes the high to here, but not up to the band. And then the next candle is unable to even beat that price. This is the formation of the top. Here, we also see it, even though it broke the band for a second with its surge of the high, the close was not anywhere near be able to breach the top, and the next band fell below. So this is how we know that we have these double tops. And that's what they're trying to indicate, because they're unable to breach the upper band. Okay, now, how do you know that that's what you got? You will see a divergence between the RSI signal and the price action in the Bollinger Band or the price movement. So in other words, when you see price moving up to form that double top, to form the first top, what you see in Bollinger Band and the RSI indicators, you see a divergence where the indicator is making lower highs and diverging from the price. So we can see we can put a trend line or a line across the tops of the RSI, and it's on a downward angle, where when we put a line across the tops of the price, it is moving up. So it is a true divergence. Okay. So this gives you a continuation signal. During a consolidation, price spikes into the outer band, which gets rejected immediately, and we get a reversal signal. So when price is rejected by the upper band, that's giving us a reversal signal. When we get the RSI divergence, we're getting a continuation signal. You can get this in more detail right on the Bollinger Bands website. So this screenshot, and I'm sorry, it's so small. I don't know how it ended up so small here. And I don't have a larger one. But the screenshot shows both scenarios. We have the scenario one here, we have the divergence, and the scenario two, when we have the price unable to violate the upper band. So during trends, okay, the moving average holds very accurately and breaks, and the break of the moving average is usually a meaningful signal that the sentiment has shifted. Okay, so in other words, when we have price moving up and is moving towards the upper band, but it breaks above the moving average or breaks below the moving average form stands as a crossover. When you get that crossover, it's telling you that sentiment shifted. So during the trend, the moving average could have been used as a re-entry signal to add to existing positions during pullbacks. Furthermore, the moving average can be used as a trade exit signal where a trader does not close his existing positions unless price has broken the moving average. So as you can see here in this shot, we have price moving up, and it's doing what we call riding the bands, and price should be moving in this direction, push and ease, push and ease, push and ease. When we see it cross the moving average, it's generating a signal for us. So here you see price pushed up. It was unable to break or breach that upper band. It fell back down. We got the cross below the moving average, which is now doubly telling us that we should be seeing a price reversal, and we should be entering the market in shorting the market or in a sell position. Here we got the crossover right here, and we see the end of the previous downtrend and the price moving into an uptrend. So when you saw here, the price wasn't able to breach, it still isn't telling you it's going to move into a downtrend. This crossover works as your entry signal. So while Bollinger Bands are exceptionally helpful in determining when an asset has overshot to the upside or downside, it's important to use the bands to also set risk conditions, not just entries. Additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk rewards during lower volatility and higher risk rewards during high volatility. And you can use, basically the saying is, everything you need to do and know is contained within the bands. So you can set your stop loss, okay, depending whether you've gone long or short, on the opposite band. And you can set your entry and your exit points based on the bandwidth. So in contrast to other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot of important information this way. There are a few things you need to pay attention to when it comes to using Bollinger Bands. During strong trends, price stays close to the upper band. When price is riding in an uptrend, it should stay near the upper bands. And like I said, this is what we call riding the band. And when price is riding the band, it's telling you that that price will stay where it is or continue that trend. And it's almost a picture perfect of it. Okay, so this is what we call riding the bands. See how price hugs the band? When price, even though it's moving in a downtrend or an uptrend and moves into the center of the band and is no longer in a downtrend hugging the bottom band or an uptrend hugging the upper band, it's telling you that the strength of that trend is lessening. Okay. When it is at the band and riding the band, it is so this is what's telling you that this trend here has momentum here. Okay, this is how strong that trend is. It's got very, very strong. Now it's going to ease what's supposed to be. Now it's still riding up, and it looks like it's a very strong uptrend. But you see it's unable to hug those bands. And it ends up getting violent. It doesn't mean it's uptrend. It's not telling you the uptrend is going to end. It's telling you it's not as strong as it was. Okay. Same thing. See here we have this downtrend. It's hugging the band. Now it's still moving down, but it's moved into the middle of the bands. So it helps you see what is going on in the marketplace. Okay. We also want to pay attention to if price pulls away from the outer band as the trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the outer band show a lack of power. A break of the moving average is often the signal that that trend is ending. So in other words, when you're riding the bands and it's still moving up, but it seems to cross the moving average, okay, it's telling you that that trend is most likely ending. So in this screenshot here, we see the entire scenario of Bollinger Bands. We see riding the bands, then we see it unable to violate the lower band here, even though the candle pushed down and the low and the swing lows, but swing lows weren't able to violate the band. They moved back up, and see how they touched the band and then fell off the band here, moved back up and again weren't able to violate the band. That tells you that uptrend is now petered out. It moved back up in one last ditch effort, but still not able to violate that, to breach that upper band. And then we start riding the bands downward. But then it moves inside the bands into a consolidation period. And even though it's fall back down, it isn't riding the bands and it's not hugging those bands. So it's telling you that strength of this down movement isn't that strong, and it moves over to a consolidation. We also see it here breaking the moving average. Okay. We see it here. So this is the point where we have this uptrend. It bounced off of, wasn't able to continue this downtrend. This is the point right here where it crossed the moving average that we would have considered entering this market. And we could have ridden this market into that upper band violation here, which is still a nice amount of points. We could have ridden that euro from 130 to 132. Gave us a clear-cut exit signal. And even if we didn't get it there, we would have exited when the second point here, and we still would have made a lot of pips. So John Bollinger Bands, and John Bollinger, as the markets developed, online trading got bigger, charts got more accurate. He developed what's called a percent B. It's an indicator that depicts where price is in relation to the bands, and then added bandwidth to depict how wide the bands were as a function of the middle band. For many years, this was state of the art. Bollinger Bands, percent B, and bandwidth. Percent B is an indicator for measuring the distance between the Bollinger Bands. In other words, it's measuring the volatility in the markets. Appropriately, this indicator is called the Bollinger Bandwidth, or just a bandwidth indicator. It is simply the value of the upper band less the value of the lower band. Understandably, the asset with a higher price tends to have a higher band reading, and it just doesn't matter unless you're buying stocks. But in my opinion, the percent B component of the Bollinger Band allows you to better pinpoint proper entry and exit points when trading stocks. Okay. And it's simply, or Forex, when it's simply the difference between the width of the bands. Percent B is an indicator derived from Bollinger Band and quantifies a security's price relative to the upper and the lower band. And it's very easy. Okay, you don't have to you can drop it right on the chart. You don't have to do any calculation, but it's really a very simple indicator. Percent B equals 1, or you assign it a 1 when price is at the very upper band. When price is at the lower band, you assign it a 0. Percent B is above 1 when the price is above the upper band. Percent B is below 0 when it is below the lower band. Percent B is above a half when price is above the middle band. And percent B is below a half when price is below the middle band, which is the moving average band. But again, you don't have to do any of this. It's dropped on your charts. But let's not freak out. You don't have to do any calculations. You just locate it on your charts, on your indicator list, and you see it in Bollinger Bands percent B, and you click it and drops it on as an indicator below your charts. Now, this helps you see the value of the difference or the volatility in the markets. When you combine your interpretation of price movement and the moving averages here, you combine it with volume, and you can see the peaks and the troughs of the indicator of the volatility. you then have 3 pieces of valuable information indicating what's happening in the markets. So ideally, when buying security, we want the percent B reading to be below 0.1 for multiple days or multiple time periods. The lower the percent B reading is and the more days or time periods in a row, the more oversold the security is and the greater the historical edges have been. This is key to trading Bollinger Bands, and by applying a few additional filters, you are then able to build a trading strategy with high average gains. When you are trading with Bollinger Bands, and especially the percent B component, you want to be as structured and rule-based as possible. The rules are generally the same for each market, but you need to set the right levels for the market that you're looking at. Because day trading, successful day trading is mostly a game of pennies. The best firms and individuals, traders who day trade are looking to scalp just a few small amount. Using Bollinger Bands and percent B shows that intraday edges do exist. You can use these to make many trades during the day and get a lot of positions in with small, steady profits. But you also have to look at exit strategies, and Bollinger Bands will help you see where to put your stop losses, because you can see the volatility of the markets and you can see the price movement within the Bollinger Band. So you'd want to set your, if you, like I said, you want to set your stop loss based on the opposite side of the band and your take profit on the other side. So as you can see, knowing how to exit a Bollinger Band trade is as important as knowing how to enter one. By looking at various precise exit points, you're able to see more variations with higher edges and historically high probabilities of trading success. Successful day trading is mostly a game of pennies. So there is a precisiveness here using Bollinger Bands. In this way, using the precisiveness to your advantage. Now, there are literally hundreds of variations. There, from the, there's just everything. You have to figure out a trading style that fits you. I look for, like I said, the crossover, the violations, the upper and lower bands, and a surge in moving average. Okay, again, it works very well with RSI as a second indicator. Write your rules, figure out how you want to do it. Calculate where you would like to, where your stop loss should be, where your take profit point should be, what you should use for your entry point, and you can find everything you need just by using RSI, percent B, volume, and Bollinger Bands, and you have a whole entire trading system. Okay. Now, there's different types of indicators or strategies you can use. Bollinger Band squeeze is like one of the most popular. It's been around for a long time. The Bollinger Band squeeze is a straightforward strategy. It's relatively simple to implement. First, look for securities with narrowing Bollinger Bands and low Bollinger Band levels. Ideally, Bollinger Band wish should be near the low end of its 6-month or 6-time period moving range. Second, wait for a band break to signal when to start a new move. In other words, when price breaks out of the band to the upside or the downside. And we're going to look for it to ride the bands and then ride out. Okay. And each one of these will give us your perfect Bollinger Band squeeze. We trade when it breaks out in the opposite direction of the breakout. So even though the Bollinger Band squeeze is a straightforward, charters should use at least combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below the support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure. Because the Bollinger Band squeeze does not provide any directional clues, chartists must use other aspects of technical analysis to anticipate or confirm. And like I said, support and resistance, RSI, volume. So, guys, I'm going to take you over and show you one chart with the Bollinger Band squeeze on it, and then I've got to say goodnight to you. So let me pop this up. I've got a beautiful chart set up here. Okay, so this is a beautiful Bollinger Band squeeze. So we're in this case, we're using it with 2 other moving averages and we actually see the Bollinger Band break out of the bands right here, and we see our 20-day moving, our 50-day moving average also breaking the band, and this is giving us the perfect squeeze to then enter that market for an up movement. Okay, so the Bollinger Band squeeze occurs when the volatility falls to low levels and the Bollinger Band narrows. According to John Bollinger, periods of low volatility are often followed by periods of high volatility. Therefore, a volatility contraction or narrowing of the bands can foreshadow a significant advance or decline. Once the squeeze play is on, a subsequent band break signals the start of a new move. Okay, so we saw the band break right here. Okay. A new advance starts with a squeeze and subsequently a break above the upper band. A new decline starts with a squeeze and subsequently a break below the lower band. Now, this is a chart for Ripple against, I don't know. It's you know, all these new cryptocurrencies, but it's not for any other purpose except show you the Bollinger Band. And now what they're saying is they're expecting price to continue moving up because they're expecting an announcement from Coinbase that they're adding Ripple to their trading platform, which should give Ripple a price in a push in price. So we had the advantage to take it here. Now we're going to take it up to here. And this is your typical Bollinger Band squeeze. And on that note, guys, I've got to say goodnight because I've got to get out of here and head to the airport. And I'm going to wish everybody a happy and healthy holiday. And we'll see you on, I believe it's January the 3rd. And then we'll see you every Tuesday and Wednesday night in all of next year, actually. So, uh-oh. I lost my last slide here. Let me just get it back up here. The only way I can get to it is go, actually, yeah. Just my wind up slide. And then I'm going to say goodnight and wish everybody a happy holiday. I just lost it again. Hold on a second. I'll get to it this way. So you can now see that the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buy and sell balances, and potential trend shifts. Together with the moving average RSI Bollinger Band make for a great foundation of a trading strategy. Add this and always remember, no matter what you're trading and how you're trading, you should always be looking at volume. So on that note, I will say goodnight to y'all. We'll talk to you again real soon. Thank you for being part of the ETX family. Thank you for supporting us. Thank you for trading with us. And we'll see you next week. Great now, and enjoy your holiday season. Bye now.